Hello and welcome back. In Chapter 13, we talk about financial ratios. A ratio is just simply a relationship between two key financial numbers on the financial statements. It's kind of like A divided by B is equal to C. Well, what that ratio does, it kind of helps us to standardize the number so we can compare to ourselves over time or to compare to our competitors or the industry. And it helps us to identify some of the strengths and weaknesses of a company. So financial ratios are used by financial managers to evaluate what do we need to improve on in the company, or to maybe evaluate our business strategies. It's used by credit managers. If our firm is going to extend credit to our customers, well, who do we extend credit to and who do we not? Security analysts will look at financial ratios. If I'm a bond analyst or a stock analyst, I'd like to know the strengths and weaknesses of a company. Bankers obviously would want to know these kind of ratios to determine if the borrower can pay the loan back and is the company solvent. Labor unions can use them to negotiate wage rates. Even students or job hunters, before you go to work for somebody, maybe to evaluate some of their financial ratios to see their strengths and weaknesses. So, again, a ratio is just simply a comparison between two financial numbers on the financial statements, and it helps us to standardize that relationship. So in the text here, we talked about four different basic categories of ratios: liquidity, activity, financial leverage, and profitability. So liquidity ratios deals with short-term, 12 months or less, assets and liabilities. Do we have enough cash or near cash assets to pay our near-term obligations? And you heard me say early on in the course that cash is the ticket to play the game and cash flow is the lifeblood of an organization. Do we have enough cash to meet our obligations? Liquidity deals again with 12 months or less, short-term obligations. Activity ratios measures how well management uses the assets of a company. We think about things like the fixed assets, those long-term assets. How well do we use those to increase sales, for example? On a short-term basis, we look at things like inventory turnover. If I'm a retailer, I'd like to evaluate how many times do I turn over my inventory in a particular year. The slower I turn it over, the worse. I want to turn over my inventory fast. If I'm a business that extends credit to my customers to incent them to buy, if I'm a furniture company that gives you credit to buy furniture, I have an accounts receivable. So I'd like to measure how fast my customers are paying me on my accounts receivable. In terms of financial leverage, think of it as debt, borrowed money. The more borrowed money that we use to finance our assets, the more financial leverage we have. So a very popular leverage ratio is called the debt ratio. Total debt divided by total assets. What percentage of our assets is being financed with borrowed money? I oftentimes think about various companies in the recent time frame that have increased their leverage. They've increased their debt because interest rates are low. In terms of profitability, two popular measures is return on assets and return on equity. Return on assets is the net income of the company divided by the total assets of the company. It tells us how much did the company earn with the assets that it had. Return on equity is the net income divided by the total equity, the stockholders' money. You might recall on the balance sheet that we have the total equity of the shareholders. So how much money did the company make with the stockholders' money? So those are kind of the key financial ratios that were mentioned in the text. Now, another thing that the text talked about was firm valuation, putting a value on the firm. Well, there's two basic thoughts here. One is called the market value, and the other one is the book value. The market value of a firm is just simply based on what the stock buyers and sellers are selling the stock for. So if I were to take a look at what a stock is selling for example, Walmart, I think Walmart today is probably trading at about $142 a share. If I take that and multiply it by the number of shares outstanding, that's called the market cap or market capitalization. That's what the stock market thinks that the business is worth as a total. So the market value is determined by the marketplace, the buyers and sellers of the firm's stock. If there's more buyers than sellers, that's going to have upward pressure on the stock price. If there's more sellers than buyers, that's going to put a downward pressure on stock prices. The book value is an accounting number. It's the total equity on the balance sheet, and it basically reflects the historical value of the assets minus depreciation, and it takes into account all the retained earnings, the money that the company has made in the past that it didn't pay out in dividends. And so oftentimes I tell students that the book value of a company doesn't tell us a lot because it's based on historical asset value. For example, if I bought a building or a piece of real estate 30 years ago and I've depreciated it down to a lower number, well, today I probably could sell that real estate for significantly more than I bought it for. So that's called what I call a hidden asset on the balance sheet. The balance sheet doesn't really reflect the true value of that asset. Conversely, I might own some software, some kind of technology that I paid a lot for, but today it's obsolete because it's being replaced with a new technology. So the market value is much more significant in determining the value of a company than the book value. How do we determine an investment's return or an investment's value? The annualized rate of return the annual return on an investment would be the change in the value, the price that you paid for it versus the price that you could sell it at today, plus any income. So for example, on a share of common stock, what's the value of the share of stock at the end of the period minus the value of that stock at the beginning of the period? That's the change in value, plus any dividends that I received during the year. That's the annual return per share. And if I divide that by the price that I paid for the stock initially, the price at the beginning of the period, that's my annualized rate of return on the stock. So in today's world, I think of it this way. I have a capital gains yield. That's the difference in the price that I paid for versus what I could sell it for today. And I have a dividend yield. If the company pays me a dividend, that's kind of like a bird in the hand. In today's world, when the stock prices are so high, a lot of investors are saying, you know what, I want to buy a stock that pays a dividend because I don't know for sure or not feel quite confident that the stock prices are going to go up much more from here. So that's just a couple different ways to think about that. An older individual might like to have a stock that pays a dividend because I might need that income to live on. A younger person who's invested in stock isn't buying the stock for current income. They're buying it for a long-term capital gains. So they might look for a stock that has a more stronger growth pattern. Okay. So a PE ratio. The PE ratio is the market price in the numerator divided by the earnings per share in the denominator. The earnings per share is the net income of the company divided by the number of shares of stock outstanding. So again, the PE ratio is the market price per share in the numerator, the earnings per share in the denominator. And so when you think about it, the reciprocal of that, earnings in the numerator, price in the denominator, is kind of a crude measure of earnings. So obviously, if I'm a buyer of a stock, I would like to buy it at a lower PE ratio. If I'm a seller of the stock, I would like to sell it at a higher PE ratio. Now, there's two basic reasons why a stock might be trading at a higher PE ratio. I think the stocks in the long run probably average in the 16, 17 PE ratio. Individuals will pay 16 to 17 times the earnings for, I mean, the stock market as a whole in the long run is right in that range. Well, in today's world, some stocks are trading at 30, 40 times earnings. In fact, some companies has a price when the earnings is negative. So that's a negative PE ratio. That doesn't make sense. But if there's two basic reasons to have a higher PE ratio. One is I'll pay more for $1 of earnings if I think the earnings are going to grow. I'll also pay higher PE ratio. I'll pay a higher price per dollar of earnings if there's less risk. To say that another way, if the earnings are riskier, I'm going to pay a lower price for the stock. So PE ratio is a common measurement. You'll see it in the financial news every day on various stocks and bonds and so forth. Another ratio similar to this is what's called the PEG ratio, P-E-G, PEG. The numerator is the PE ratio. The denominator is the growth rate in earnings or dividends. And so the theory is that the PEG ratio should be about 1. The PE ratio should be about the same as the growth rate in the earnings. And what that means is if you can buy a stock with a PEG ratio less than 1, that means that you're buying at a lower price than the growth rate. You might find a attractive purchase price for the stock. So those are some simple kind of comments that we have about the financial ratios chapter. And so we'll see you in chapter 14. Have a great day.